Oliver Velez.
Thank you. Thank you. Thank you. We've got a fantastic showing for you. This is actually the first time I am doing a presentation on core trading. Core trading, in my opinion, is a very critical, should be a very critical part of everyone's investing and or trading program. And we're going to cover a great many concepts today that you should be able to, once mastered, add to your trading arsenal, and of course, dramatically increase your investing performance. All right, we'll talk about a variety of things, things such as the fact that there are 4 styles of trading that fall into 2 broad categories. We'll talk about the dynamics that have primarily changed this industry. We'll talk about the things that have contributed to why you are here listening to me today. All right, and I believe, I'm a history buff, and I believe that virtually every single market player should be somewhat of a history buff, because history, as far as the markets are concerned, really truly do repeat themselves over and over again. Successful trading comes down to a few very basic concepts. All right, it's not as complex as some would have you believe. All right, it's not as mysterious as you may actually feel it is. The principles behind proper market play, the concepts that form the foundation of successful trading, are very, very simple in nature. Doing them is the hard thing. Give me 1 to 3 days, and I can teach you virtually every single thing you would need, ever need, to make a successful living in the markets, if that's truly your desire. All right, but after a 1 to 3 day period and obtaining every single tool necessary, every single tactic and technique necessary to make a living in the markets, the real challenge begins. That challenge is the conquering of the self. Once you have a very intelligent methodology under your belt, once you have the right tools, once you have the right techniques, and so forth and so on, your number one enemy is you. Okay? Knowing what to do is no guarantee that you do it. All right? Knowing what to do is actually the easy part. Today, it is, I believe, quite fortunate that a number of very highly successful market players have decided that it's financially rewarding enough to stand in front of audiences and talk for 8 hours a day. This is a very positive development in the industry today. When I started trading 14 years ago, 14 and a half, almost 15 years ago, no one was interested in teaching you. Why? There was no incentive. All right? When I opened the doors of Pristine.com 7 years ago, none of you showed up. All right? Today, all right, we are in the midst of a phenomenal revolution that's only in its infancy. All right? And those who get prepared today, those who get the right education, the right tools under their belt, stand to be the new titans of a brand new game. Many of you have witnessed me or heard me in the past talk about the fact that the powers that be are in the process, as we speak, of setting up one giant stock exchange. Not a NASDAQ, not an American, not a Pacific, not a Japanese Nikkei. One giant American exchange, which ultimately will turn into one giant electronic worldwide exchange, open 24 hours a day. All right, 24 hours a day, on which you can trade virtually anything on planet Earth that moves. Rocks, trees, stocks, options, bonds, naughty children, in-laws, back and forth. You don't want them? Offer them. All right? This is actually happening today. Every computer sold will have a uniform platform where within 5 minutes you'll be able to open up a trading account, select the broker-dealer of your choice, and be up and running and alive as a real, live, active, professional market player within 3 to 5 minutes. But the most amazing thing that's being worked on now is the fact that you and I very shortly will be trading through our television sets 24 hours a day. Upper left-hand corner, you can have, for instance, late at night one night watching Jay Leno, and in the upper left-hand corner is your portfolio, right? Ticking in real time, right? Probably commanding more attention than Jay Leno. And with one click of your remote control, you can change from Jay Leno to someone else, With another click, you can buy and sell securities 24 hours a day. All right, some of you very hyperactive types can forget about sleeping, all right? Which means that Starbucks can be bought anytime, right? All right? But these dynamics are happening as we speak today. And what is really the most phenomenal thing is that the individual public has finally stood up and said, you know what? I can lose money all by myself, all right? I don't need to pay someone to lose my money. I can lose it all by myself. So give me part of my money back, and I'm going to be a self-directed, active market participant. I am telling you that we are at the cusp of a time where a match is about to be lit, and worldwide explosion of market participants is about to explode on the scene. This must happen. It is going to happen. All right, your NASDAQs and the New York Stock Exchange, they're linking exchanges all over the world to create this 24-hour highway. All right, and successful trading comes down to one thing. It is this. Successful trading is the art. You've heard me say it many times. It's the art of finding two groups of ill-informed market players. It is not the art of finding what the best company is. It is not the art of finding the company with the strongest earnings. Successful market play has nothing to do with how powerful the products of a company are, how strong its management are, how strong its fundamentals are. Wrong. That's the game that has been historically sold to the general public. Successful trading is the art of finding two groups of ill-informed market players. Far too many traders fail to realize that every single time you place a buy, someone's on the other side of that transaction selling the stock to you. Every single time you press the sell button, someone has eagerly stepped up to the plate to buy the stock from you. The $64,000 question is, who's smarter? Is it you, or is it the person taking the other side of your trade? Successful trading is the art of finding two groups of ill-informed market players. Group number one, those blinded and incapacitated by pain that are willing to, at precisely the wrong time, to give up their merchandise at a price that you know is way too inexpensive. That's group one. Group two, those blinded and incapacitated by a phenomenal amount of greed, willing to buy that same piece of merchandise back from you at a price that you know is way too expensive. Successful trading has always, forever, and forever will come down to one thing. It is the art of finding an idiot. It is not the art of finding earnings, momentum, strong management. Do you think that a stock coming across the screen of a NASDAQ market maker, a 5,000 share buy order for WXYZ, the market maker in the stock, sees this 5,000 share buy order, looks at it, do you think his first question is, what was the quarterly earnings for this stock last quarter? Is the management strong? Is the company doing the right thing? What did the last 3 to 5 analysts say about the stock? No. You know what his first question is? Is this 5,000 share order from an idiot? Or is it from someone who really knows what they're doing? Because the answer to that question will determine how he handles the order. An idiot, I'll fill it. Someone smart, I'll act as an agent and go out in the market and stick it with someone else. All right? Successful trading is the art of playing people. And the concepts we'll talk about today in core trading form will be concepts that are designed to teach you how to capitalize off of two very important points, the only 2 points you need know how to find in the market. The point where fear stops and greed shows itself for the very first time. The other point is when greed is running a marathon and then all of a sudden stops. And for the first time, after greed has run a race, fear shows itself for the first time. Those are the only 2 points in the market, the only 2 transitional points you need to know how to find. All right? The concepts we'll talk about today are designed to teach you how to find those specific points. All right? Let's begin. Very quickly, we have the course we're about to go over is broken up into 4 sections. In the introduction, we will cover a few items. A major time shift, which has been something that I consider to be quite incredible. There has been a major analytical shift in the market and in the industry as well. And of course, we'll talk about the differences between fundamental analysis and technical analysis, and why, of course, we always believe that the technical approach is the far superior one. The next section, we'll move into the foundation. This is the area that forms the cornerstone of my entire philosophy as it relates to core trading. We'll talk about the 4 styles of trading. We will actually go into core trading to define precisely what it is. We'll also talk about core trading versus investing, and most importantly, the idea that there are 2 forms of core trading, the macro version and the micro version, both of which are extremely powerful. In the third section, we will cover the key events. This is going to be the heart of our core trading seminar. And in this section, we will cover 3 very well-defined key events that you will walk out of here knowing how to spot and identify in the markets. I've always taught that successful traders need only 2 or 3 consistent items to make a living in the markets. 2 or 3. And we'll cover 3 today. The following section, of course, we'll cap off with taking the foundational concepts, the key events, and designing specific strategies that will help you walk into the market week by week and extract profits. Let's start off with the introduction. Let's talk about this phenomenal major time shift. Fact number 1. 20 years ago, the typical investor looked to hold a stock for 4.5 years. Just 20 years ago, the average holding time for an individual stock was 4.5 years. Fact number 2. Today, the typical investor looks to hold a stock position for 4.5 months. This is a phenomenal shift in the typical holding period. I'm quite aware of the fact that your parents and your grandparents would never have dreamed of holding stocks for 4.5 months and flipping them. All right? 4.5 years was probably, for many people, too short. Most people played what I call the Rip Van Winkle approach to the markets. You've heard me say that before. That's when you buy a stock today, you take a nap for like 10 years, and hope everything is okay when you wake up. Well, today, that is an ineffective way to play the markets. No longer do individual companies dominate their niche like they used to in the 1930s and the 1940s. No longer can you count on the fact of a company staying ahead of the pack for 14 years, 20 years, and 30 years. All right? The cycle changes so rapidly today that you, as a market player, had better be prepared to weave in and weave out on a shorter term basis. I've got 2 theories to talk to you about. They are my theories. Theory number 1. We believe the investor's average holding period of any stock will drop from 4.5 months to 4.5 weeks inside of 2 years. This time shift is in the fastest part of the shift. Many people during the year 2000 learned that holding on for extended periods of time does not work. All right? I believe that this shift continues to drop. Theory number 2, which means that long-term investing, commonly referred to as the typical buy and hold approach, is no longer an effective way to play the markets. Now, I know that I will conjure up many arguments from people as a result of stating this theory, but it is absolutely true in my opinion. Do you know that the number 1 enemy or the number 1 fear of the CEOs of major technology firms like Microsoft and Sun Microsystems and Oracle, do you know their number 1 fear is? It is not the major company down the street or across the country. It's the 18-year-old who has nothing else to do but sit in his basement or his garage thinking up a way to come up with a better technology. Do you know that technologically we live in a different world every 8 months? And because of that, no longer can we count on buying a stock or a company with the idea of it dominating its niche forever. It simply does not work today. All right, and there are some major dynamics behind this change. What has actually led to this dramatic change? And again, we're going over parts of the history which I believe are very important to understand. Fact number one, we've experienced a 25-year decline in commission rates. That's one of the items that has actually led to this dramatic shift. You realize when I placed my first professional trade, I bought 1,000 shares of Intel. It cost me $1,500 in commissions. 1,000 shares of Intel, $1,500. $1,500 in, $1,500 out. Could I possibly have been a short-term market player? No. 25-year decline in commission rates started with May 1st, 1975, when the U.S. deregulated commission rates. Most firms actually raised rates. Others, like Charles Schwab, kicked off a brand new industry, the discount industry, and lowered rates, which moved into the deep discount industry. And of course now, it virtually costs us pennies to play the stock market. The barrier to entry has been lowered, making short-term market play actually more viable today than it used to be. What else has led to this dramatic shift? A worldwide collapse in interest rates. Very, very important, making equity participation an absolute must. All right, how many people remember the days where interest rates in money markets used to be 21%? Early 80s? All right, who needed the stock market? 21%, 18%, 19%. Today, do you know what the average interest rate for a 30-year Japanese bond is? Zero. Zero. 30 years, you can hand your money to the Japanese government, and in 30 years, maybe you'll get the same amount of money back. Maybe. Okay? Zero interest rates. Now who needs the stock market? Everyone. If you happen to have any interest in staying ahead of the inflation monster, you had better be involved in the stock market. All right? What else has led to these things? Phenomenal technological advancements. Right? Today, virtually every single intelligent person on the earth has some form of access to a PC or a computer. What else? New order handling rules. Thanks to a former Fed chairman who was a champion of the individual, new order handling rules that have helped to make the playing field just slightly more level has also led to this dramatic shift, making it more possible for individuals to play like professionals. Do you realize that at one point in the past, only a few years ago, that if you wanted to sell a stock, advertise to the entire world that I am a seller of this stock, it was up to the market maker to decide whether or not he was going to show your order to the rest of the world or keep it hidden? Well, because of new order handling rules, he must show the order. He must advertise it to the rest of the world and so forth and so on. So new order handling rules have led to that. What else? The advent of the internet. The advent of the internet is not only changing the way we see, feel, and think about the world, it's changing the way we see, feel, and think about the markets and the way we potentially profit from the markets. The internet has done one very, very important thing. It has narrowed the gap between the source of information and the final recipient. And I want you to understand how potent this is, because the key to wealth in any industry has historically been controlling the gap between one thing and another, whether it's the gap between the bid and the ask, the gap between the original source of information and the final recipient. Whoever controls that gap has a key to a limitless vault. And for decades upon decades, the powers that be, those who could buy through wealth the access to early information, controlled and dominated the markets. Today, because of the advent of the internet, the gap between the source of information and the final recipient has gone to virtually zero, so that the playing field as far as information is concerned is close to being equal or level. All right? This is another reason why markets turn and flip and stocks rally and crash so rapidly, because information today is disseminated to the final recipient much faster. And who do you think the final recipient is? Little old us. It's us. Think about this. If you knew that Microsoft next Friday was going to announce bankruptcy, what would you do? You would immediately get up out of your seat right now, leave me, all right? Go knock on every single door all the way to your home, get on the phone, call everyone you can to borrow as much money as you possibly can, all right, to short Microsoft. Well, do you realize that for decades upon decades that there were people who had access to the information long before it got to you and me? The advent of the internet has solved a big part of that problem, making it more possible for us to play on a level playing field. What else? A more sophisticated public. All right, today, because of the internet, because of the increased information, we actually have developed a more sophisticated market public, a public that says, you know what? I can lose money all by myself. I can do it all by myself. I can gain access all by myself. And I'm starting to realize that I know more than my salesman or my broker. All right? Fundamental analysis versus technical analysis. Let's talk about fact number one. 20 years ago, fundamental analysis was considered the only proper way to make market decisions. Today, the purely fundamental analyst is virtually extinct, even on traditional Wall Street. Yes, I know that the fundamental analyst is the #1 talking head on programs like CNBC and so forth and so on. But when it really comes down to where these firms put their money at, they are now banking with the technical analyst. This is a statement that was made precisely by Mark Douglas. He's the author of The Disciplined Trader and Trading in the Zone, 2 excellent books that I strongly encourage that you read. The dynamics of the analytical shift, what has led to those things? Money, right? It is now a very well-known fact on Wall Street that you make more money from a technical approach than from a fundamental approach. Why? Because markets are not mathematically logical and or rational, right? They don't follow some mathematical formula like PE ratios, okay? The hopes and fears of people actually move stocks, not numbers. I can put a stock certificate on this table and it will not move. It takes fear, the fear and greed of one group and another group clashing together to cause the stock price to move, all right? Not numbers. Another realization is that under extreme fear and greed, people react the same way over and over and over again. We will learn through some of the concepts we talk about today that we are nothing more than Pavlovian models that salivate at the tinkering of a bell. Every single time, right, one thing happens, we react the same way. Every single time another thing happens, we react the same way. Every time you are in pain, you react the same way, typically by hitting the sell button. That is where I step up to the plate and help you sell it, all right? And every single time, all right, we are experiencing greed, we react the same way. And this is what sets up some very interesting technical phenomena. Charts are the footprints of these actions and reactions. Next one. Basically, in other words, charts do not lie. CEOs lie. Analysts lie. You can have a CEO on CNBC talking about how positive his company is and how strong his products are, how much they dominate their niche, while he, his wife, his girlfriend, and the janitor are all dumping the stock. But you know what? Every single action must be printed. And because it's printed, it must form the chart. Charts do not lie. Numbers lie. I started my career, my professional career as an accountant. That is why I'm a technical analyst today. All right? What I was asked to do, trust me, I lost all faith in numbers. Have you heard the recent news of about Arthur Andersen? All right? Being sanctioned for huge amounts of money for painting reports and so forth and so on. So, all right, charts do not lie. And I want to know, as a market player, I want to know, is the chart matching the talking mouth? If the chart is matching the talking mouth, then the talking mouth is okay to listen to. If it is not, I default to the chart. Let's move into the building blocks. This is now we're moving into the foundation part of the course. These concepts will form the cornerstone of our entire core trading philosophy. There are 4 trading styles: core trading, swing trading, guerrilla trading, and micro trading. I'll repeat that. There are 4 styles of trading based on Pristine's philosophy: core trading, swing trading, guerrilla trading, and micro trading. These 4 styles fall into 2 broad categories. The 2 categories are the wealth building category, and the income producing category. 4 styles of trading that fall into 2 categories. Let's talk about them in greater detail. Wealth trading styles.